G'day expats and welcome to another episode of Expat Chat, episode 135 today, and I'm joined with my co-host Adam Prentice, who is one of our specialist expat financial planners that's based in the Dubai office and is a specialist for the Europe, Middle East and Africa's region. We don't have Brett on today, but we do have Adam. G'day Adam, how are you, mate?
Hey James, yeah, very good, thank you. Actually became an uncle last night,
Ooh.
so sister had her first baby,
Lovely.
so yeah, lot to be happy
Absolutely,
about.
mate. When do you think you'll get some time off? When will Brett let you take some time off to go and see the young whippersnapper?
Good question. Look, probably July sometime. Might meet up in Europe somewhere. She's actually living in New York, so bit
Geez, you're
difficult.
just a family of expats, aren't you? Your parents are over retired happily in New Zealand. You grew up in Hong Kong. You're now in Dubai, and your sister's in, was it New York?
Yeah, New York. So yeah, scattered all over the world. I think it's hardest for my parents being away from us. But
Absolutely. But gosh, tell you what, you've got some real world front of the line experience there, which I think a lot of your clients do love, which is great. And mate, today, continuing on from the theme last week, I want to do another Q&A session. We've got some great comments which come from our Facebook again once more. Great questions, I should say. That is the Australian Expat Financial Forum. Feel free to jump in there, join. There's some great things going on there. Love the community spirit that we have going, everyone helping each other out, and often an expat that's got an issue that they're facing maybe in Italy, someone maybe in the US has already solved it if it's along the personal financial sort of side, and we're always there trying to moderate things and help out where we can. Before we jump into today's Q&A session, mate, just a quick disclaimer for our listeners. Anything you hear today should not be construed or taken as personal financial or personal tax advice. Should be just consumed for information and entertainment purposes only. If you do need tax advice or financial advice, please reach out to a firm like us, Atlas Wealth Group, where we can assist you. Mate, we'll jump into some of these questions, and there's a few to get through today, which I'm looking forward to, picking your brain a little bit. First question I'm actually going to throw over to you, and then we'll bounce one back to me after that. So, hi, Brett and team. Is it risky leaving cash in a Middle Eastern bank account, or should I put excess savings in another country? I'm going to kick that one over to you, Adam.
yeah, definitely. Look, thanks for the question. What we tend to do for our clients is keep money in Australian bank accounts. Australia, probably the most regulated country in the world. Good corporate governance, consumer protection. We know the banks are, too big to fail. As well, holding funds in AUD as well, where a country, you're likely to return to, even if it's just for a holiday at some point. It limits out that currency risk. So what we do for a lot of our clients is dollar cost average with exchange rates. You just move the same amount back each month, take the emotion out of it, and then your funds are sitting there in AUD waiting for you to get back. Because I don't know about you, James, but I've never seen a client happy with the exchange rate on the date that they actually want to leave the country.
No.
So yeah, there's the currency aspect of it. Then the laws we're governed by here in the Middle East too. So we do have dictatorships that they can change rules tomorrow, and we all have to live with it. Therefore, I think of the scenario where all of us expats are trying to leave at the same time. We're all trying to pull money out of Middle Eastern bank accounts. Obviously, banks have liquidity requirements, but that's not going to be a good situation, and funds will, in order to be stuck there. Then we get into things like geopolitical risk as well. While we are safe here in the UAE, it's not to say it's always going to be like that. It's a much smaller risk, but it's something to note. So, yeah, generally we do keep most of our funds offshore.
Yeah, good question, mate, and good answer there. And it really, it ties in a little bit to this question I was going to answer about a couple. So I'll read it out, and it is just regarding savings and opening up bank accounts. But it says here, we're looking at non-US bank accounts to diversify our portfolio. My husband is a dual US Australian national, and I'm a US citizen. We are currently living in the US. We want to know what the tax implications are if we open up an Australian bank account Only other accounts we have is my husband's superannuation account. So it's a good question. They're asking about tax implications. Your husband should be able to open up an Australian bank account. Sometimes you can face hurdles, which is verifying maybe yourself, because maybe your husband hasn't been back into Australia for a while, and that can prevent a little bit of a hurdle initially. So it might even require a trip back to Australia. But if you continue to remain in the US, then I would assume you're non-residents of Australia. So if you're going to be putting some funds in there, earning some interest, it would mean that some withholding tax would come out, which is normal, 10% on interest. If the interest or the withholding tax is higher, it means they need more tax information from you, which is usually going to be a tax identification number, such as your US SSN, your social security numbers. So not really too much of an issue there, not really tax implications. It's just a case where that 10% withholding tax needs to be applied on the interest. You'll be declaring that interest in your US tax returns. It's a final withholding tax. Because tax is withheld on Australia, you don't need to report it on any Australian tax return either. Our interest rates, they're dropping 4.35 to 4.10 now. So you'll start to see that in banks and mortgages, but we're still giving out a good income yield on cash, but not as good as obviously franked dividends, those sort of investments. But a really good question there. Another question I'm going to kick over here to Adam. Has anything happened with the new legislation in regards to non-resident for tax purposes?
Yeah, a question we've been getting quite a lot recently after all of what we were publishing, probably around this time last year. The short answer is no, nothing has happened, and the reason for that is the upcoming election. So probably in May 2025, maybe April, there are campaigns going on at the moment. So Labor want to, try and get it through. So look, no movement in this space. We do want to see changes. It'll make things more black and white, but yeah, nothing until 1st July 2026 earliest, and that would be even a bit of a stretch. So
yeah, absolutely, mate. It's a bit of an unknown because we'll be going back to vote again, I'd say April, and we'll see what the new government has an appetite for. But I don't know if that's going to be a priority. I happen to agree with you at the moment on that one. But a good question and a good update there. Question for me here regarding US and US exit tax. So, hello, if you're planning to leave the US, would you be likely to qualify to pay exit tax as per the HART Act? Does the capital gains exemption apply to both realised and unrealised gains from the year of exit? Also, is the $890,000 per individual or a couple filing jointly? There's a little bit in that one, and that's really granular. So a lot of our listeners will be hearing that and going, what the hell is the HART Act? What is he talking about? And, rightly so. So the HART Act, it was introduced a long time ago, and it was mainly to tax, foreign nationals that were in the US that were relinquishing their green cards, and potentially if they were a US citizen. It was a final tax to capture them. It was actually introduced around Facebook, and they were trying to capture one of the founders of Facebook, Eduardo, and they brought it in to try and tax him on his billions and millions of dollars of wealth because he was relinquishing his green card. They've kept it around now, and it's a really important exit tax which funds a lot of different things. The capital gain exemption for this question, that does apply to realised gains and unrealised gains in the year that you're exiting. Absolutely. You get 500,000 USD if you're filing jointly on the main residence in the US. And then the exemption, or the CGT exemption, that applies on an individual basis. The same with the net worth test of $2 million US. That's not gross, that's individually. So if you own property jointly, you own other assets jointly, you split it down the middle, and that's how you're assessed. It's a good question. Exit tax is a bit of a minefield, so I would recommend seeking some advice. If you need some assistance on that one, have a consult with us, but we've got some great professionals, this is all they do, exit tax and all the minefields and plan around it. So touch base, but great question there. Tough one to answer easily. We'll move on. Another question here for Adam. Hi, Brett. Something I'll be facing. We'll just insert Adam in that one. Hi, Adam. Something I'll be facing in the future. Are there different planning and tax implications when you have an Australian life insurance policy versus a death benefit paid as an annuity? I have an old A&P endowment policy since the 1980s, that is old, that will pay out when I reach 65. I believe this would be tax-free as an Australian tax resident, but not sure if it is as a non-resident. Over to you, Adam.
Yeah, I had this one the other day actually, and look, you have indicated this policy is old and very not familiar in the market these days, but as it is a life insurance policy that you have alluded to, generally, yes, that is tax-free in Australia. If you're a non-resident, it won't be seen as that. I don't think so. Look, in terms of what we did for our client is you can actually roll these policies into other super funds. It is like the old Stone Age, though. You do have to lodge paper forms in trying to get them rolled in. James, I think you actually were involved in that
that's
process.
right. I remember this client, and I mean, it was an old policy. I just couldn't believe some of the paperwork. I forgot what century we're in. So they still do exist, and they're not very digital. A lot of old paperwork things can't be e-signed, and other things like that. Snail mail as well, which is always fun. Yeah, these policies still do exist. They still provide some great benefits, but a lot of the time they haven't sort of moved to more of a digital platform, I would say.
Yeah. The big concern for our client in this situation was he resides in the UK. Therefore, if he is pulling out, Australian superannuation funds, therefore it will be taxable in the UK because obviously our pension system doesn't line up to theirs.
Yep.
So
no, it doesn't at all. Good question there, though, and yeah, it just goes to show a lot of different minefields when you are a non-resident and how, I suppose, assets back in Australia can be taxed or not taxed. And that sort of is a nice segue into this next question about CGT Event K3. So I've got a question here saying that apparently Australia has a rule regarding inheritance, and if a child lives overseas and is a foreign resident, apparently something to do with CGT. We've got assets and shares overseas and in Australia. What would happen and how would we distribute these to get around this issue? So that's a really good question. It's not one I'm going to be able to cleanly answer today, but I'll just explain the inheritance issue that we're talking about here. So capital gains tax event K3 is when a foreign resident is receiving something like a share or is receiving some sort of shares through the estate. Because a non-resident is technically treated as a tax-favoured vehicle, it means that the capital gain of those shares that they're receiving actually has to be taxed on the day of death tax return or the estate. The drawback of that is that it does create this unequal or inequitable, I suppose, estate assets, because you're paying tax on something that ordinarily you wouldn't pay tax if all the beneficiaries were just Australian tax residents. So it does create a bit of an issue, and it can leave, I suppose, the foreign resident or the non-resident, the Australian living overseas, at a disadvantage to maybe their siblings. So how does one rework this sort of estate plan? If there's a way that you can gift cash through the estate rather than assets that have, I suppose, CGT values, or they're, I suppose, traded on exchange or anything like that. Giving cash directly, we don't actually have any gifting tax here in Australia. So that's fine. There's not going to be a further tax on cash that's being received. But if you're gifting shares, that will trigger CGT Event K3 when you're gifting them through the estate to a non-resident. So that's the issue that does arise, and you do need to rethink your estate plan. Often an estate plan will break down the estate into percentages. I'm going to give 10% to Adam, I'm going to give 5% to my brother Andrew, and my other brother Matthew, he's going to get 0.5% because I hate him. So that's a quick example. Everything else is going to go to a charity, obviously. So that's really common with percentages with estates. But in this instance, as part of your letter of wishes, you might need to dictate, if we have cash as part of the sale of the main residence, that cash is to go to, say, the individual that's a non-resident, because they're not going to pay any further tax on that. The main residence needs to be sold down within 2 years, so it still benefits from the exemption, and a few other things go into it. That's just a bit of an example. It does require planning, but also requires a tough conversation to have with your parents if they are getting on, and to reconsider how they've designed their will. A little bit in that one. But I think that's as best as I can answer it today. Next question for Adam here. It's regarding investment properties. So are there any legalities regarding taxes on investment properties when you're a non-resident, and how do you reduce it? Over to you, Adam. Broad question, that one.
Yeah, a strategy we often implement. So, as I'm sure the listeners know, any sort of Australian property is Australian taxable property. What that means is you still have to lodge a tax return with income minus expenses in it. Whatever that figure is at the end, if it is positive, the first dollar that you earn, you'll pay tax at 30%, which is the base rate for non-residents. Not a good tax outcome, particularly for people sitting here in the Middle East. So what we try and do is we create debt, and what that debt does, or taking funds out of the offset account to make that figure at the end either just negative or maybe just slightly positive, so you're not paying too much tax. There are ways to play with this and use the funds for better investment returns, because things like accumulative returns v funds sitting in an offset account that you and Brett have had this argument before over these calls. So yeah, there are ways to do it and create deductions against your property for sure.
Yeah, absolutely. Couldn't agree more, mate. And it's just one of those things. Give the funds a bit of a purpose, bit of negative gearing. Expats can get negative gearing benefits. They just don't realise it straight away. It's delayed gratification. So you've got to be patient until you come back. Last question here, Adam, for you again, mate. Leaving Indonesia we'll go with leaving Indonesia soon. I think that's a typo. Leaving Indonesia soon and having my BPS, that's just a type of local Indonesian pension, paid out. So having my BPS paid out, my superannuation here also not like it. The funds can be transferred in. Has anyone done this before? Just going to paraphrase that one because I think there's some spelling errors. Leaving Indonesia soon. I'm getting my BPS paid out. Is there any way that I can just put this into my super or transfer it into my super?
Yeah, so the short answer to that is no. The Australian superannuation system only lines up against two different type pension systems in the world where you can directly transfer in. One is the UK and the other is New Zealand's KiwiSaver. And yeah, even trying to get a UK pension into Aussie superannuation tax-free is a very difficult process. So yeah, unfortunately not. Sorry.
Yeah, I agree with you, mate. It's not easy. Often, I suppose, foreign pensions and funds, which are unique, like a lot of the time it's safe to get a private ruling on them, just so you have absolute clarity of how it's going to be taxed. Once you have that, it means you can come to a firm like us and we can help you actually plan from a tax point of view of how you now squirrel it in and get it into your super fund. But yeah, there's not many out there that you can just transfer straight into Australian super, as Adam put. That's actually our last question for today. Getting that on, that's been a great session. Just a bit of housekeeping before we wind up today's episode. Next week, on the 5th of March, we have the pre-election property insights that's hosted by Jeremy Harper, Managing Director for Atlas Mortgages. He's getting a guest on, which is Jack Hennison, who is the Director of Hennison Advocacy. They're going to be providing some great property insights for 2025 and any little ways that you can squeeze as much juice out of your situation to invest via property as well. So keep an eye on that one. There's two sessions. There's the Europe, Middle East and Africa session on the 5th of March, and then there's the APAC session a day later, just trying to do those in really comfortable times. Guys, if you love the podcast and you've been following us for a while, we really like a rating and a review. And give us that thumbs up. It just makes us spread the word a little bit more to our community. In the meantime, we'll be getting Adam back on. We'll be picking his brain once more, especially around the UK stuff very shortly. As always, Adam, it's been great to have you on, mate.
Yeah, great to chat to you, James, and thanks, everyone.